There's a sentence in the U.S. tax code that lets a married couple sell their house for $500,000 in profit and pay zero in federal tax on the gain. It's not a deduction, it's not a deferral, zero tax. I'm going to show you exactly how the rule works and one mistake that disqualifies most sellers without them ever knowing it. And a move at the end that lets you do this every 2 years for the rest of your life. I'm going to walk you through 5 things. Number 1, exactly what the rule says in plain English. Number 2, the one ownership trap that disqualifies most sellers. Number 3, the 3 boxes you have to check to qualify. And 4, the 4 questions I get every single time I post about this. And 5, the move at the end that turns this from a one-time tax break into a strategy you can repeat for the rest of your life. Here's why this matters. A married couple sells a house. They bought it for $250,000, sold it for $750,000. That is $500,000 worth of profit. Without this rule, that profit is taxed as long-term capital gain. At today's federal rates, that's roughly 20% on most of it, plus a 3.8% surtax on investment income. So about $120,000 to the IRS. If you add in a high tax state like California or New York, and you're closer to $180,000 gone before you even pay your realtor. With the rule, zero. The IRS takes nothing. So here's the rule in plain English. The IRS calls it the Section 121 exclusion. Everyone else calls it the home sale tax break. If you sell your primary home, you can exclude up to $250,000 of profit if you're single, or $500,000 if you're married filing jointly. It's not a deferral and it's not pushed to next year. That gain disappears from your tax return entirely. The IRS treats it like it never happened. $250,000 single, $500,000 married, tax-free. And one thing to know, these limits have not changed. They were set up in 1997. They were never indexed to inflation, and Congress has talked about raising them, but as of this recording, they're still the same numbers. So everything applies to anyone selling a home this year. Now here's where most people get disqualified before they even start. To get this exclusion, you have to pass 2 tests at the same time. The IRS calls them the 2 of 5 rule. Test number 1, the ownership test. You have to have owned the home for at least 2 years out of the last 5. Test number 2, the use test. You have to have lived in that home as your primary home for at least 2 out of the last 5 years. 2 years owned, 2 years lived in out of the last 5. Those 2 years don't have to be the same 2 years, and they don't have to be the most recent 2 years. They just have to add up to 24 months somewhere inside the 5 years right before the sale. Here's the trap. People sell a vacation home. They sell a rental. They sell a house they just bought and flipped, and they assume the exclusion applies, but it doesn't. If you can't check both boxes, the IRS treats the whole gain as taxable. Okay, you understand the rule. Here are the 3 boxes that determine whether you actually walk away with the exclusion. Number 1, the home has to be your primary residence, not a vacation house, not your second home. The IRS looks at the whole picture, where your mail goes, where you register to vote, where your driver's license says you live, and where your kids go to school. Number 2, you can only use this once every 2 years. So if you sold a primary home last year and used the exclusion, you can't use it again on the second home you sell this year. The clock resets every 2 years. Number 3, there's a partial exclusion if your move was for an unforeseen reason. A job change at least 50 miles away, a serious health diagnosis, a divorce, a death in the family, even twins. The IRS lists these in the rules and gives you a prorated piece of the exclusion based on how long you actually lived in the home. Most sellers don't know that rule number 3 exists, and they assume because they didn't hit 24 months, they owe full tax on the gain. But if there was a real reason you had to move, you still may get a serious chunk of the exclusion. That can be the difference between a $50,000 tax bill and zero. Before we get to the move at the end, here are 4 questions I get every single time. Question number 1, what about a rental property? This exclusion is for primary residences only. A pure rental that you've never lived in does not qualify. But here's what most people miss. If you convert a rental into your primary home and live in it for 2 of the next 5 years, you can unlock a partial exclusion. It's prorated based on the years it was a rental versus the years it was your primary, but the door is open. Don't sell a rental in a hurry. Talk to a CPA first about the conversion play. Question number 2, does my mortgage matter? No. The exclusion is based on gain, the sell price minus what you paid for the home minus capital improvements. Your mortgage balance has nothing to do with it. You can sell a paid off house or one that's underwater. What the IRS taxes is the gain, not the cash you walk away with. Question number 3. What if my profit is more than $500,000? So anything above the limit is taxed as long-term capital gain. So if a married couple has an $800,000 worth of profit, the first $500,000 is excluded. The remaining $300,000 is taxed at long-term capital gain rates, which is about 20% federal for most people. That's still a massive win. The first chunk is fully tax-free. Question number 4. What if I rented it out for a few years? Now, this is the gotcha. If the home was ever rented out, even just for a few years, the depreciation you took during the rental period gets recaptured. That means it's taxed at up to 25%, even if the rest of the gain qualifies for the exclusion. So a couple walks away with $500,000 worth of gain, tax-free, but if $40,000 was taken in depreciation during the years it was a rental, that piece is taxed separately. So just plan for it and don't let it be a surprise on your tax bill. The biggest mistake I see that people make with this rule is selling a property that doesn't qualify because they don't understand the timing. The most common version, selling a rental property, assuming the exclusion still applies, it doesn't. If you haven't lived in it as your primary home for 2 out of the last 5 years, the IRS treats the entire gain as taxable. The second version, moving out of a primary residence and waiting too long to sell. Once you've been gone for more than 3 years, your use test fails. The clock can run out without you even noticing. The rule is simple, but the dates are unforgiving. If you're still inside the 5-year window, you can pull this off. If you've crossed it, the exclusion is gone, even if the home was your primary residence for 15 years before that. Just mark the dates and talk to a CPA before you list your home. Okay, this is the move that can make you millions. This rule does not have a once-in-a-lifetime cap. You can use the Section 121 exclusion every 2 years for the rest of your life. So watch what happens when you stack it. A married couple buys a home, they live in it for 2 years, they sell it for a $500,000 profit tax-free, they buy the next home, live in it for 2 years, sell it for another $500,000 of profit tax-free. You do that 4 times over 8 years, that's $2 million of profit with 0 federal tax. That same $2 million from any other source, a business sale, a brokerage account, a side hustle, would lose nearly $500,000 taxes. Now the market has to support it. The moves have to be real moves and your family has to be on board, but the rule allows it. And in markets where the appreciation is real, people have built generational wealth doing exactly this. This is the only legal way that I know of to turn your primary home into a tax-free wealth building machine. So let's lock it in. Section 121, exclusion, erases up to $250,000 of profit if you're single, $500,000 if you're married. You qualify by passing the 2 of 5 rule, 2 years of ownership, and 2 years of use, somewhere inside that 5 years before the sale. You only get it on a primary residence and it only once every 2 years. If life forces you to move early, the partial exclusion can still apply to you. The move at the end, repeat it every 2 years and you've turned your home into the most powerful tax-free asset most Americans will ever own. Skip this rule and you'll send the IRS more on a single house sale than most people save for retirement in an entire decade. If this is the first video of mine you've watched, I teach people how to build wealth and retire early. Hit subscribe so the next one shows up in your feed.